Gold has been on a run this year, rising 50% from $1,200 to $1,800 per ounce. This is 1 gold ounce for reference for this dimensions, which is really no bigger than a thumbs up. The rally is due to concerns around a prolonged recession and slowing global economy, the US-China trade war that keeps on going, an ultra-low interest rate environment combined with too much free money being printed, and stockpiling of physical gold in recent years by the central banks of India, China, and Russia. People looking to gold consider it an insurance against economic disaster and protection against long-term inflation, like Big Macs, which have increased in price by 4.5% every year for the last 20 years. But as good of a defensive investment it can be, it's worth mentioning that it's also vulnerable to risks. If any of the concerns I mentioned earlier start to reverse course, or people desperately need to liquefy their gold for cash, then gold prices can decline, just like it did back in 2013. But it's often just another wait until the next disaster happens. For stocks, it's usually extremely difficult to pick the right gold company because it's very expensive to operate mines, and more fail for a variety of reasons than do succeed, regardless of the gold price. But if a company has been doing well in the last 5 years and 10 years, then they might be onto something right and should be given a second look. If picked correctly, gold stocks can increase much more than the price of gold if their profits are expected to grow faster. So I'll show you the 4 best Canadian gold investments this past decade, and also compare it to the gold ETFs. In no particular order, here we go. Kirkland Gold, mostly working with underground gold mines. They have gold mine locations in parts of Australia and Northern Ontario, Canada. They recently acquired Detour Gold for $4.9 billion, which was 37% of Kirkland's size at the time, and that added a large open-pit gold mining location in Northern Ontario. At the time, Detour Gold was under scrutiny by billionaire hedge fund manager John Paulson for its mismanagement by executives, and he helped encourage the acquisition. Kirkland Lake is currently $17.3 billion in market size. Their total gold mine reserves, or what's available for extraction, is estimated at 20.5 million ounces, which is worth $50 billion at today's gold price. But it's impossible to pull it all out from the ground in one day, so no company stock is rewarded the full value. In just 2019, the rate of gold production, or extraction, was 975,000 ounces. In the last 5 years, this rate has increased by roughly 33% per year. At their current production rate, they would be mining for the next 20 years at existing locations, assuming they don't expand or find new gold mines. Their all-in sustaining costs, or all necessary costs for operations and maintaining their gold mines, is at a very low $564 per ounce, and that's been improving by roughly 12% per year. At their cost today, every ounce of gold they sell gives them a profit of $1,236. Excluding gold price changes, their profits have been rising faster by 48% per year. Plans right now include focusing on dividends and stock buybacks, exploring for more gold at existing mine locations, integrating Detour Gold into their operations, and probably selling their non-core gold mines. $10,000 invested this last decade, or when they started in 2016, would have grown to $247,000, which is a return on investment of 2,370% and 92% per year. If just the last 5 years, the results would be the same. Franco-Nevada. They have some operations in Nevada, US, which happens to be the leading gold producing state in the nation, but they're ultimately a globally operated royalty company. This means that they don't own any gold mines, but they own a portion of the amounts that they produce or extract. This way, like royalty, Franco-Nevada doesn't have to do anything with running a mine, but for a deal, it gets to own gold as it's produced, typically no more than 5% of the total amount. Besides gold, they also focus on other resources, like silver, platinum, oil, and gas. No more than 20% of revenues come from oil and gas. The company is currently $37 billion in market size. As a royalty company, they don't own any of the mines, so they don't technically have any reserves. The company deals with different metals, so the amount of gold equivalent ounces they got from royalties in 2019 was 516,000 ounces. In the last 5 years, this rate has increased by roughly 7% per year. The company estimates that the mines in the royalty portfolio have roughly 19 years of production life. Their cost of operating is extremely low at $266 per ounce because they don't have any direct mining costs. But this has been slightly worsening by roughly 3% per year. At their cost today, every ounce of gold they sell gives them a profit of $1,534. Excluding gold price changes, their profits have been rising faster by 4% per year. Plans right now include raising their dividend and exploring new mine or oil locations to strike more royalty deals. $10,000 invested this last decade would have grown to $70,600, which is a return on investment of 606% and 21.4% per year. If just the last 5 years, it would be $31,600, which is 216% and 25.4% per year. Sandstorm Gold Royalties. Like Franco-Nevada, they're also a globally operated royalty company, but they're roughly 10 times smaller in scale. Some of their royalty deals may also include a bit of copper and silver. The company is currently $2.5 billion in market size. The amount of royalty they received in 2019 was 64,000 gold equivalent ounces. In the last 5 years, this rate has increased by roughly 7% per year. Their cost of operating is a very low $286 per ounce, and that's been improving by roughly 1% per year. At their cost today, every ounce of gold they sell gives them a profit of $1,514. Excluding gold price changes, their profits have been rising faster by 8% per year. Plans at the company include share buybacks, waiting for some of the existing mines that they have royalty deals with to take off in gold production, and looking for new royalty deals to buy. $10,000 invested this last decade would have grown to $47,200, which is a return on investment of 372% and 13.9% per year. If just the last 5 years, that would be $31,400, which is 214% and 25.3% per year. B2 Gold. They have gold mines around the world outside of North America, with a lot of focus on gold mine operations in Africa. The company is currently $8.4 billion in market size. Their total gold mine reserves is estimated at 6.5 million ounces, which is worth $15.8 billion at today's gold price. The rate of gold production is 969,000 ounces. In the last 5 years, this rate has increased by roughly 15% per year. At their current production rate, they can keep mining for another 6.5 years at existing locations, which at a low number may imply that they might try to increase their reserves in the future. Their cost of operating is $862 per ounce, and that has been improving by roughly 2% per year. At their cost today, every ounce of gold they sell gives them a profit of $1,038. Excluding gold price changes, their profits have been rising faster by 17% per year. Plans at the company include expansions and developments at existing mines, and feasibility testing at newer mine locations. $10,000 invested this last decade would have grown to $52,500, which is a return on investment of 425% and 17.9% per year. If just the last 5 years, that would be $36,800, which is 268% and 29.2% per year. Here's a summary of how much you would have made with an investment in each of the 4 Canadian gold companies. At the bottom, I compared it to the iShares Gold Bullion ETF, which is what you would have gained if you directly invested in physical gold, as well as the iShares Global Gold Index, which is an ETF containing the largest gold companies in the world, which are mainly the big Canadian gold miners, like Newmont, Barrick Gold, and Franco-Nevada. The top gold companies in the last 5 years made on average 242%, which is roughly 27% per year. You would have made much less in either physical gold or the gold miner ETF. In the last 10 years, the companies made on average 515% or 20% per year. Interestingly, the physical gold and gold miner ETF pretty much didn't go anywhere with the returns, and physical gold roughly matched inflation at 2% per year. From that long-term perspective, the 2 ETFs have not been very good performing investments, but at least they didn't lose money. Here's a quick summary of the operational aspects that I talked about. The companies have been producing more gold every year. Their operating costs are way below the $1,800 gold price, so you know they're all making a ton of profit every time they sell 1 ounce of gold. Most of them have been finding ways to reduce costs over the years, and when looking at the growth of their profits compared to the gold price, they were all much faster. So that's all for now. If you enjoyed this video or learned something new, click the like button and subscribe to my channel. If you're already a subscriber, remember to turn on the bell icon so you get notification of these investment ideas as soon as possible. Also, let me know in the comments below if you invest in gold, and I'll see you next time.